Hello everyone, continuing here with the IAS 16 property, plant and equipment. We have a problem here that will help us get a better feel for the concept explained in the slides. And if you have watched the video for the slides regarding PPE and IAS 16, I recommend doing so first, where we just highlight 5 points to know at the tip of your fingers to make you successful with IAS 16. So here we have Frazer Mining Inc. Frazer Mining Inc., which has a December 31st year end, received on January 1st, 2000X1, a new excavator from a domestic supplier. So here in that first sentence here, some key information, I guess, is the entity's year end, which will be key when it comes to recording depreciation and that type of thing. January 1st also tells us when we received the piece of equipment, which is an excavator, which is very common in mining there. And then also another piece of information we're getting it in this first sentence here is a domestic supplier. So from there we can right away deduct that there won't be any import duties, or it shouldn't be. So that's an important bit of information here. The following information relates to the excavator. So first we have the invoiced price, which is 675,000 in Canadian dollars. We have a HST here of 13%. So most likely FMI is located in Ontario. Supplier discount, $10,000. So FMI must be someone that deals a lot with the supplier, and as a result they're getting a discount. And lastly, there's an installations cost related to the new excavator, maybe a platform, maybe cost of bringing the equipment at the very particular location in the mine. So installation cost of $12,500. And we have 4 requireds here for FMI. The first one is we have to confirm that the excavator is really a PPE asset. So it's going to ask us basically to look at the definition of a PPE asset. Then we're asked to calculate at what cost the initial recognition should take place. Third, here we're asking to suppose that FMI estimates that the excavator has a useful life of 12 years and a residual value of $100,000. Then they're asking us to present a depreciation table for the excavator. With the information provided here, we can deduct that they're most likely looking at the straight line method. But we'll do both. We'll do both methods, the straight line and declining balance. And fourth, we're again supposing that we are now January 1st, 2000X8, and FMI has sold the excavator for $210,000 that day. So they're asking us here to record the journal entry for the transaction. So here it takes us basically through the 5 points that we presented in the slides for IAS 16. So a pretty good problem here. What I will do now is I will just hop into Excel and break down the problem using an Excel document. So here we are in Excel here. So the first one here, we're being asked to confirm that the excavator is really a PPE asset. So what is the definition of a PPE asset? So from the slides, we know that there's 2 bullet points here. First, it must be held for the production of supplies or goods. So is it met? Absolutely it is, yes. The excavator is going to be used to extract natural resources which will then be transformed and sold. So definitely the first bullet point is met. The second is must be used for more than one period. And again, there, yes, absolutely. The case tells us that the useful life is 12 years. So definitely it's going to be used for more than one period, more than 1 year. So yes, according to FMI, the assets will be used for 12 years. So we know we have a PPE asset there because it meets both the bullet points for the definition. Then now we're being asked, in part B, we're being asked to calculate what cost initial recognition should take place. So what's our definition here? So definition of the initial recognition there, again, for me, there's a pretty simple formula. Is the invoice price plus import duties less discount less non-refundable taxes. And I like this formula because for me it's easy to remember, and it covers a great majority of the problems you'll face going into the CFE or in your degree there. So what do we have here really? We have the invoice price, which is 675. Sorry. Okay. What other element we are being given here? We're being given HST. There's no adjustment for HST, and there's the reason why. HST is a refundable tax. So again, they're pretty simple point to remember. Anything that has to do with HST, GST, PST, those are refundable taxes, and those are not included or not deducted from the purchase price. They go in a separate account there. We got a supplier discount, which is 10,000. So sorry, 10,000. So minus 10,000. Okay. Counts as a discount, absolutely. And then lastly, we got the installation cost, which are 12,500, and those are being added. Okay? Any directly related cost are being added. So we got 12,500 a year to be added. So what's our total here? For this asset, as far as initial recognition, we are looking at 677,500 there for our initial cost. Okay, so again, they're pretty straightforward. In part C there, we're being asked to present an amortization table or a depreciation table. Those two words are you can interchange them, no problem. So we'll start, like I said, we'll do both methods. We'll do the straight line method, and we'll do the declining balance method. Okay, so with the straight line method there, what's our equation there for those situations? So we're looking at the depreciation amount, which is the cost minus the residual value. Okay, and we want to divide that by the useful life of the asset. Okay, so that's our formula, that's our equation here. Like I said there, you must know how to use the straight line method. That's pretty important. So let's break down those components here quickly. So we got the cost, we got residual value, and we got the useful life for our excavator there. So our cost, we said 677,500. Our residual value, according to the problem there, it's 100K, 100,000. And our useful life is 12 years. Okay, so our yearly depreciation expense it is going to be, we said, the cost minus the residual value and then divided by the useful life. Okay, so we have our depreciation expense here at 48,125, and with the straight line method this amount is the same for every year. It doesn't change. Okay, so that's what we know, that for the next 12 years our depreciation expense for the excavator is going to be just over $48,000. So now I like to do especially at the start there, I like to do a depreciation table. I just find it creates a real good visual, and in that depreciation table there's going to be 4 columns really. So there's going to be the period, right? There's going to be the yearly depreciation expense. Okay, there's going to be the accumulated depreciation. Okay, and there's going to be the net book value, or the carrying amount, depending how you want to phrase it. Okay, for the period you always start with 0. Okay, period 0 is always your first one. Then you're gonna have 1, 2, and we're gonna go all the way to 12 with the excavator, right? Got 12 years. Let me just restructure a little bit here. Perfect. Our net book value at the start here. Again, let's create a better table here quickly. Okay, perfect. So now our carrying amount here at the start obviously is the initial cost, right? Then for each period we know that our depreciation expense is the same, 48,125. Then it's important to lock both the column and the row there, and I can drag that all the way down. I know it doesn't change for the 12 years. Then the accumulated depreciation is going to be a build-up, obviously, of all the depreciation expense over the years. So always start equal the row above plus the depreciation expense for the current year, right? And then as far as the net book value or the carrying amount here, we're looking at subtracting the accumulated depreciation at the end of each period, right? So again, we're going to look at the carrying amount for the prior year, the prior period. I'm going to lock that amount as well, minus the accumulated depreciation. Okay, so now I can grab these 2 columns and drag them all the way down. And as we can see here, we see the accumulated depreciation at the end of each period, and our residual value at the end of year 12 is $100,000. So no surprise there. It works out great, and that way if I know, okay, if I want to sell the asset after 7 years or after 8 years, what is the net book value that's going to be on the books? Okay, so that's for the straight line method. As far as the decline balance there method, declining balance method. Okay, so what's our equation? What's our formula here? It's the depreciation rate time the net book value of the asset. Okay, perfect. So that's our formula for this method. Okay. Here the problem steered us towards doing the straight line method. Here let's come up with a rate, and I think a reasonable rate would be most likely 15% for an asset over 12 years. So I'm going to use 15%. Obviously, more thought would have to be put into this rate, but just for the sake of this problem, let's use 15%. Okay, so that's the depreciation rate I'm going to use. We can, again, what's the cost, what's the residual value, those inputs stay the same. What's the useful life? It's the same, so we got the cost again here at, I'm just going to borrow them from above here. Residual value is the same at 100,000, and we have the useful life of 12 years. The declining balance, the difference when I compare it with a straight line method, is that now the depreciation expense will be different for every year. It's not going to be a consistent input in my table like I did above there. So I want to come up with the same structure. So I'm going to have a period. I'm going to have a depreciation expense. I'm going to have an accumulated depreciation again. So that doesn't change again. And then I'm going to have the net book value slash carrying amount for the asset. Okay, so again, let me make that a little bit cleaner. Okay, so that's what we have here. So again, I always like to start my tables with period 0, year 0, however you want to phrase that. And again, there I'm going to drag that all the way down to 12. Well, I'm going to have to push this down a little bit. Perfect. Okay. What's the carrying amount? Obviously, no changes there. Actually, I'm just going to borrow it from above again. Easily accessible. Okay, so my depreciation expense, according to my formula, according to my equation, is the depreciation rate. I'm gonna lock that rate again, okay, because that rate never changes, and it's multiplied by the net book value of the asset, which is what it is at the initial recognition there. Okay, so the depreciation expense for the first year obviously is going to be much higher than it was with the straight line method. The accumulated depreciation, same thinking here, so I'm going to use the cell above. I'm going to add the depreciation for the current year, accumulated depreciation, and the carrying amount, same thing here. We're using the carrying amount above at the prior year. I'm going to lock that again, and minus the accumulated depreciation. So now I should have my table all set up, and I can drag, oh actually no, I gotta backtrack. No, it should work. Let's see it. Yeah, it works perfect. Okay, so obviously, as we can see there, high amount of depreciation in year 1, but then it drops down because of the way the formula works. So if we're looking at year 10, now it's only 23,000 compared to 48 with the straight line method. So a bit of a difference there. So the one thing though here, what I want to make sure is in year 12, okay, in year 12 at the end of the useful life, the 96,369 cannot be there. What needs to be there is 100,000. That's my residual value, right? So that means that depreciation for that year, okay, is going to have to be less than 17,006. So what I do in those situations there, what I'm going to do here is I'm going to overwrite the formulas in my table, and I'm going to come and put the residual value. And then obviously I'm going to override the formula here as well. And what I'm going to do here is I'm just going to go equals 113,000 minus 100,000. and that's the depreciation. And what I like to do is just changing the color of those cells just to remind myself that there was an override there, just like that. So again, there we can see both tables with the two methods there. So again, there you must know how to use those tables. You must know how those methods work at the tip of your fingers. Okay. And then lastly, there was a sale of the asset. So let's refresh our minds there. Supposing that we are in 2008 on January 1st, and then FMI decides to sell the excavator for $310,000. Why did they do that? Maybe technology has drastically improved. They can get a lot more productive. They just get a brand new asset. Maybe they feel that the asset is a little bit beat up. They would want to accelerate the timeline for a new one, to get a new one. Or maybe they're just maybe they need cash, so they decided to dispose of the asset. So there's a lot of many aspects of a decision can go in there. So we have a disposal at $310,000. So if we go back to our slides, the recognition takes place when the asset is sold or disposed of. So obviously that's not a question. We have to derecognize the asset. And going back to the slides, we know that there's three key steps you gotta follow. And first step here is you gotta record the consideration, right? You gotta eliminate from the book the cost of the asset and the accumulated depreciation. Okay, got to reverse those entries, obviously. And then lastly, is there a difference? Okay, let's put that as a question mark. Okay. If so, there is going to be a gain, gain or a loss. Okay, all right, so we got three little points here just to know as far as what to do when there's derecognitions. So okay, so what do I know? What do I know as a fact? I know that I got cash. I got a consideration here of $310,000. Okay, so if we go back to our problem, 210,000. So that's cash in my pockets. Okay, so 210. That's a debit. That's in my pockets. Then we got to reverse the accumulated depreciation. So again, that's a debit. Depreciation. Okay. And now we're at January 1st, 2008. So if I use my table, that's where my table comes handy. I'm going to use the straight line method table. So year one, we were at 2002, 3, 4, 5, 6, 7, 8. So at the 7th period there, I am at January 1st, 2008. Okay, and the carrying amount, the net book value of the excavator at that time is $340,625. Okay, so what I'm gonna do again here, so I gotta eliminate that amount. Gotta reverse that amount. What else do I know? I'm gonna skip a row here, and I know that I gotta take out of my books the asset itself, the excavator. So I'm gonna call that asset the excavator. And what was the cost? Again, if I go, I'm just gonna borrow it from this table here. That's the cost here. Okay. So now it doesn't take a math degree here to see that these two amounts, the two columns are not equal. Okay, so there's another entry that needs to take place here in the debit method, and that entry obviously is a loss. So we had a loss on the disposition or on sale of the asset, okay, and that loss equals the difference between the cost and the cash received and the accumulated depreciation. So here, kind of treat that maybe even as a plug there. I got to plug that in, the loss of the disposal there. So again, there, knowing that there's a loss now, my assumption would be they just wanted to upgrade. I would think that the technology for the asset has drastically improved in 8 years, and they just feel they can get more return with a brand new, more productive, more performant asset. So here is how to complete FMI. I hope it helps. I hope the visual was good, and we'll see you guys next time.